There is one thing you can do with your own money, your own legal money, that the federal government treats as a crime. Not spending it wrong, not hiding it, not failing to pay a tax on it, just moving it from your hand into your own bank account the wrong way. And here is what makes this so unfair. The wrong way is the way that feels safest, the careful way, the way a lot of honest seniors already do it, because someone once told them it was the smart thing to do. Let me show you exactly what that mistake is, right now, so there is no confusion. If you take a large amount of cash, and instead of depositing it all at once, you break it into smaller pieces, amounts under $10,000, on purpose, so your bank does not file a report on it, you have just done the one thing federal law was written to punish. It has a name. It is called structuring. And under Title 31 of the United States Code, it does not matter that the money is legal. It does not matter that you paid your taxes. It does not matter that you meant no harm at all. The government can freeze your account. The government can investigate you. And in documented cases, the government has kept people's money permanently without ever charging them with any other crime. My name is Kevin, and this video exists because most of the seniors doing this right now have absolutely no idea they are doing anything wrong. They think they are being careful. They think they are staying out of trouble. They are walking straight into it. I spent the last several weeks going through the Bank Secrecy Act, Title 31 of the United States Code, Section 5324, the IRS Internal Revenue Manual on Civil Forfeiture, and the real court cases where this happened to ordinary people. By the end of this video, you are going to understand exactly what triggers this, exactly how to move your own money safely, and exactly what to do if you have already made this mistake without knowing. Stay with me, because the part most people get wrong is the part that feels the most responsible. To understand how a legal deposit becomes a federal crime, you have to understand the number at the center of all of it: $10,000. Most people have heard that banks report cash deposits over $10,000. That part is true. It has been true since 1970. The Bank Secrecy Act requires your bank to file a report, called a currency transaction report, every time you deposit more than $10,000 in cash. That law was expanded after 2001. The reporting got tighter, the systems got more automated, and the number of these reports filed every year is staggering. Banks file roughly 17 million of them annually. 17 million. Now, here is where almost everyone gets it wrong. That $10,000 figure is not a limit. It is not a cap. It is not the most you are allowed to deposit. You can walk into your bank tomorrow and deposit $50,000 in cash, completely legally. The bank files the report goes to a federal agency called FinCEN, and nothing happens to you. Because the report is not an accusation, it is a receipt. It says a large cash deposit happened, and here is who made it. If your money is legitimate, that report sits in a database and never touches your life. In fact, most of these reports are never even looked at. Studies of the system found that law enforcement accesses only a small fraction of them. They are filed, they are stored, and for honest people, they are forgotten. So depositing a large amount is not the danger. The danger is trying to avoid the report. Let me say that again, because this is the whole video. Depositing a large amount of cash is legal. Trying to avoid the report on a large amount of cash is a federal crime. I told you it had a name: structuring, defined in federal law under Title 31, Section 5324. Now let me show you exactly how serious the government is about it, because the penalty is not a slap on the wrist. If you break a large sum into smaller deposits, specifically so the bank does not file that report, you have committed a felony. Not a paperwork mistake, a felony, punishable by up to 5 years in federal prison, and a fine of up to $250,000. And if the amount is large enough, over $100,000 in a 12-month period, the penalty doubles. 10 years, $500,000 fine. And the law does not care where the money came from. Read that again in your mind. The law does not care if the money is legal. You can be a retired teacher. You can have sold a used truck. You can have inherited money from your mother. Every dollar can be clean, taxed, and documented. If you broke it into smaller deposits to avoid the report, you broke the law. The source of the money is irrelevant. The only thing that matters is the intent to avoid the report. And here's the part that makes this genuinely dangerous. Back in 1994, Congress changed the law. Before that change, prosecutors had to prove that you knew structuring was illegal, that you understood you were breaking a law. After 1994, they removed that requirement. Now the government does not have to prove you knew it was a crime. They only have to prove one thing: that you intended to avoid the report. Think about what that means. You can genuinely believe you are doing the smart, careful, responsible thing. You can have no idea that structuring is even a word. You can have never heard of Title 31, Section 5324, and you can still be prosecuted, because ignorance of the specific law is not a defense. The only question that matters is whether you were trying to stay under the line, and if you were, the intent is established. Now let me tell you why honest people fall into this. Because it feels responsible. Somewhere along the way, somebody told a whole generation of Americans that keeping your deposits under $10,000 keeps you off the radar, keeps things simple, avoids attention, avoids an uncomfortable conversation at the bank. That advice is not just wrong, it is the exact thing federal law defines as the crime. The moment you deposit $9,000 instead of $10,000 for the purpose of staying under the line, you have done the one thing the statute was written to catch. Let me tell you about Walt. Walt is 71. He lives in rural Missouri. He spent his life farming, corn and soybeans mostly. The same land his father worked before him. Last year, Walt sold a tractor he owned outright, sold it to a neighbor he had known for 30 years. The price was $47,000, paid in cash. Every dollar of that was legal. Walt owned the tractor. He sold it fairly. He fully intended to report the sale on his taxes. There was nothing hidden about any of it. But Walt did not have much experience with large amounts of cash. He had never dealt with a sum like this all at once. And he had heard, somewhere, at some point, maybe from a friend, maybe from something he read, that the bank gets involved when you deposit more than $10,000. So Walt decided to be careful. He deposited $9,500. Then a week later, another $9,500. Then again, and again, spreading $47,000 across several weeks, to keep each deposit under the line, to avoid the paperwork, to avoid the attention. He thought he was being smart. He thought he was avoiding trouble. What he was actually doing was creating the exact pattern that federal monitoring systems are built to detect. Because here is what Walt did not understand. The system is not looking for large deposits. It is looking for deposits that seem designed to stay just under the reporting line. 9,500, over and over, just below 10,000, every single time. To Walt, that was caution. To the algorithm, that was a signature. The signature of someone deliberately avoiding the report. Walt's bank flagged the pattern. The account was frozen. The IRS civil forfeiture unit moved on the funds. Not because of the tractor, not because of any tax problem, solely because of how he deposited his own money. Think about that moment for Walt. A 71-year-old man walks into his bank one morning, tries to pay a bill, and finds his account frozen. His own money, locked by the government. Walt got most of it back, eventually, after more than a year of legal proceedings, after paying for a lawyer out of the money he had left, after the fear of watching his own savings held by the government, for a crime he did not know he was committing. And the only reason he got it back at all was that he still had the receipt from the tractor sale, the bill of sale, the proof. If he had thrown that receipt away, like most of us would after a private sale to a neighbor, he might never have seen that money again. Now, I want to pause here, because what happened to Walt is preventable, completely preventable, with information he did not have. That is exactly why I put together the Quiet Rules. It is a plain English document, $27 at kevinexplains.shop, and the section on cash deposits lays out step by step how to move large amounts of your own money without ever creating the pattern that flagged Walt. The right way to deposit, the documentation to keep, the conversation to have with your bank first. If you ever expect to deposit proceeds from a vehicle, a property, an inheritance, or any large cash sum, this is the reference that keeps you on the right side of a law most people have never read. 7 days. If it does not help you, reply to the receipt and I will refund it myself. kevinexplains.shop. Now let me show you why 2026 makes this more dangerous than any year before it. Because the trap Walt fell into used to require a large single event, a tractor, a house, an inheritance. That is no longer the only way in. In 2026, the entire federal payment system went electronic. Executive Order 14,247, signed in March of 2025, directed the Treasury to stop issuing paper checks. Your Social Security now arrives by direct deposit. Your tax refund arrives by direct deposit. Your pension, your veterans benefit, every federal dollar flows directly into your bank account electronically. That sounds convenient, and it is. The paper check is gone. The government said it was about fraud and cost. Paper checks get lost. Paper checks get stolen. Electronic payments are faster and safer. All of that is true. But here is what it also did. It connected your bank account directly to the federal financial monitoring system in a way that is faster, more automated, and more complete than anything before. Every electronic deposit is a data point. Your account number, the amount, the date, the source. For most of history, these federal systems operated separately. The IRS had its records, Social Security had its records, FinCEN had the bank reports. They did not talk to each other in real time. That has changed. Now the data can be cross-referenced against your tax return, against Social Security records, against the reports your bank files on your cash activity, automatically, faster than any human could ever do it. The systems that used to be separate now talk to each other. And that changes the second trap, the one that does not require a single large deposit at all. It is called a suspicious activity report. Your bank files a currency transaction report on cash over $10,000. That has a threshold. A suspicious activity report has no threshold. None. Your bank can file one, on any pattern, any amount, any time its automated system decides your activity looks unusual for you. And you will never know. By law, the bank is forbidden from telling you a suspicious activity report was filed on your account. Let me tell you about Eleanor. Eleanor is 68. Her husband passed 2 years ago. She inherited money from her sister last year, paid out in installments over several months. Every payment was legal. Every dollar was documented at the source. But the deposits came in irregular amounts, several thousand here, a few thousand there, spread across months, landing in an account that mostly just received her Social Security. To Eleanor, this was just her sister's estate being settled. To the bank's automated monitoring system, it was a pattern, a senior account that normally received one predictable deposit, suddenly receiving irregular sums from a source the system could not identify. The system does not know Eleanor. It does not know about her sister. It does not know about the estate. It knows the pattern changed, and a changed pattern to an algorithm with no context can look exactly like the thing it was built to catch. Eleanor did nothing wrong, but her account activity generated a report that she was never told about, based on money she inherited legally, simply because the deposits did not match the profile the system expected of her. And there is one more layer to this. Once that report is filed, it can be matched against Eleanor's tax return. The government looks at the deposits flowing into her account. Then it looks at the income she reported. And if those two numbers do not tell the same story, the system flags a mismatch. Eleanor's inheritance was not taxable income. She did not owe tax on it. But the money still flowed into her account. So on paper, to an automated system, it can look like money she received but did not report. Now she may get a notice, a letter asking her to explain money that was never taxable in the first place, money she inherited from her own sister. She will have to prove it. She will have to document it. She will have to show the estate paperwork. To satisfy a system that flagged her for the crime of grieving and inheriting at the same time. This is the part almost no one explains. You do not need to make a single deposit over $10,000 for your account to generate a federal report. You just need a pattern your bank system does not recognize. And in 2026, with every system connected, those patterns are being caught at a speed and scale that has no precedent in the 56-year history of these rules. If this is the first time anyone has explained to you that avoiding the report is the crime, not the deposit, then subscribe, because this is what this channel does. We take the rules the government buries in statute numbers, and we put them in plain English before the letter arrives, not after. Now here is why this hits seniors harder than anyone else. Think about the profile of a typical retired person's bank account. For years, it does the same thing every month. Social Security comes in, a pension comes in, bills go out. Predictable, steady, the same rhythm month after month. That steadiness is exactly what makes a change stand out. When a senior who has received the same 2 deposits every month for a decade suddenly starts receiving irregular sums from selling a home, from an inheritance, from helping an adult child, from cashing out an old policy, that change is dramatic. To the monitoring system, it is a flashing light. A younger person with a chaotic financial life, money in and out constantly, different amounts every week, does not stand out the same way. Their baseline is already noisy. But a senior's account is quiet. And in a quiet account, any unusual movement is loud. That is the cruel irony. The very stability that defines a careful retirement is what makes the unusual deposit so visible. Seniors are also the ones most likely to have received the bad advice. The generation that was told decades ago, keep it under 10,000 and you stay off the radar. That advice was wrong then. It is dangerous now. and it has been passed down kitchen table to kitchen table for 50 years. Now let me give you the protection. Because everything I have described is avoidable, completely. There are 5 steps. Every one of them costs nothing but attention. Step 1. Never break up a deposit to stay under $10,000. Ever. If you have $15,000 in legal cash, deposit $15,000. Let the bank file the report. The report is routine. Millions are filed every year on honest people. It documents a transparent deposit and then it disappears into a database. The single large deposit is safe. The broken up deposits are the danger. Never forget which is which. And this applies to withdrawals too, not just deposits. If you need to take out a large amount of cash, take it out in one transaction. Do not spread it across days to stay under the line. The same law applies in both directions. Structuring is structuring, whether the money is coming in or going out. Step 2. Keep the documentation. For every large deposit, keep the proof of where it came from. A bill of sale for a vehicle, the estate paperwork for an inheritance, a statement from the account you transferred from, a settlement letter, a closing document from a property sale. You do not submit it with the deposit. You just keep it somewhere you can find it, in case the bank ever asks. Walt got his money back because he had the receipt. Eleanor could prove her inheritance because she had the estate documents. The documentation is the wall between you and a year of legal fees. Keep a folder, a physical folder. Every large transaction, one page explaining where it came from. If you never need it, you have lost nothing. If you do need it, it is everything. Step 3. Tell your bank in advance. If you know you are about to deposit a large sum, or a series of deposits from one source, call your bank first. A 5-minute phone call explaining, "I sold a property. I am depositing the proceeds in installments. Here is why." Creates a note in your account file. That note gives the monitoring system the context it otherwise lacks. It is the difference between a pattern that looks suspicious and a pattern the bank already understands. The algorithm flags the unexplained. When you explain it in advance, there is nothing left to flag. You have turned a red flag into a footnote. Step 4. When in doubt about the tax side, ask before you deposit. If you are ever unsure how a large sum should be reported on your taxes, call a tax professional before the money hits the account, not after. Because the place where large deposits, federal reporting, and your tax return all intersect is exactly where small mistakes become expensive problems. A retired person receiving an inheritance, selling a home, cashing out an old investment, each of those has a different tax treatment. Some are taxable, some are not. Knowing which is which before the deposit means your bank records and your tax return will tell the same story. And when they tell the same story, there is no mismatch to flag. A phone call beforehand costs you nothing. Fixing it afterward can cost you everything. Step 5. Check your own IRS account. Log in to irs.gov. Set up your online account if you have not. It takes a few minutes. You verify your identity, and then you can see what the government sees. Look at your transcript. If there is a mismatch between what your bank reported and what your tax return shows, you want to catch it now, while it is a question, not later, when it has become a collection action. Most people never look at this. They wait for a letter. But by the time the letter arrives, the problem has already advanced. Checking your own account puts you ahead of it. You see the discrepancy before the system acts on it. And catching it early costs a fraction of what fixing it late will cost you, in money, in time, and in stress. Those 5 steps build a wall. Deposit in full. Document the source. Notify the bank. Ask before you act. Check your own records. That wall stands between you and a system that is powerful, fast, automated, and completely indifferent to whether you knew the rules before it caught you. I want to close with something honest. The Bank Secrecy Act was written in 1970 to catch money launderers and drug traffickers. The people who wrote it were not thinking about a retired farmer selling a tractor. They were not thinking about a widow settling her sister's estate. But the system they built cannot tell the difference. It is an algorithm. It sees patterns. It does not see people. It does not know that Walt farmed for 50 years. It does not know that Eleanor is grieving. It only sees deposits that do not match a profile. And here is something worth sitting with. That $10,000 threshold was set in 1970. It has never been adjusted for inflation. In 1970, $10,000 was a great deal of money. Today, in 2026, $10,000 is a used car, a modest home repair, a few months of assisted living. But the line has not moved. which means every year, as prices rise, more and more ordinary transactions cross a threshold that was designed to catch only the largest and most suspicious movements of cash. The net was built for criminals, but it has been catching more and more ordinary people every year, simply because the line stayed frozen while the value of money did not. And the power behind that net is real. The power to freeze an account, to seize funds without a criminal charge, to make you prove your own money is innocent, rather than making the government prove it is guilty. That power is documented. It has been used. And it has hurt people who did nothing wrong. There are court cases, real ones, where the government seized tens of thousands of dollars from ordinary people, based solely on how they deposited it. No drugs, no fraud, no other crime, just the deposit pattern. Knowing this does not change the law, but it does explain why those 5 steps are not paranoia. They are the minimum any careful senior should take to make sure they never learn this system the hard way. Because the truth is simple. The system is not your enemy if you understand it. The report is not a threat if you deposit honestly and in full. The monitoring is not a danger if your account and your tax return tell the same story. For the person who deposits their money transparently, documents where it came from, and reports their income accurately, none of this is a problem. The people getting hurt are not the ones with complicated finances. They are the ones who made one uninformed decision, who broke up a deposit because someone told them it was smart, and who found out too late that the advice they trusted was the exact behavior the law treats as a crime. Do not be that person. You now know more than they did. Use it. The Quiet Rules has the full cash deposit protection framework, the exact steps, the documentation checklist, the script for the call to your bank. $27 at kevinexplains.shop. 7-day guarantee. If it does not give you real peace of mind about your own accounts, I will refund every cent. And if you want me to look at your specific situation, email me at kevinexplainsofficial@gmail.com. Small fee. Most people save 10 times what they pay. I am Kevin. Thanks for watching. Do not forget to check the Quiet Rules at kevinexplains.shop.